Good morning. Welcome to the trade setup right here on BloombergQuint Live. I'm Neeraj Shah. It promises to be an interesting week of trade, not just the day. Remember, I said that the first few days the bias might be towards the downside, and then, well, you never know how it will shape up. As things stand, markets have turned negative for 2022. FI's net sold 4,254 crores, which is the largest amount in February till now. Brent crude is hovering around 70-year highs. CPI inflation has risen for the fourth consecutive month at around 6%, and gold has seen safe haven buying. So lots is happening. Keep in mind, Russia has kept the door open for diplomacy as Ukraine has hinted its concessions. So that's amongst the key news. Russian foreign minister suggested to President Vladimir Putin that Moscow should take a diplomatic route. And oil, like I said, has steadied near the 7-year high on the Ukraine-Russia tensions. What should an average EM investor who's investing in India do in such a scenario, and what's the global perspective? Well, I think we resort to getting in the expertise of Mr. Jeffrey Dennis every time such a thing happens. He needs an introduction now on this show at least, and otherwise, and he joins in right now with his perspective. Jeffrey, great having you. Good evening. Thanks for
Thank
joining
you.
in.
Thank you.
Jeffrey, before we get to the US Fed, because that is something that will be maybe front and center in a couple of days from now, because of the minutes, just a word on how would you think markets in general and emerging markets in particular would behave because of this unpredictable geopolitical situation that is in front of us?
Well, classically, of course, a political situation like this, especially if it turns into something like a military confrontation, is going to lead to a flight to quality. And that flight to quality typically is towards things like US treasuries, the US dollar, and away from emerging markets. So the simplistic response here is that it will hurt emerging markets at the margin. Now, we've seen that a little bit today with the dollar being stronger, and I think that's another move that you would expect to see. So I think the markets are at the moment pricing in probably a strong possibility of some sort of military confrontation. I'm not a political expert on this, and so I don't want to give a particular view on the Ukrainian situation, but any outbreak of military hostilities would, I think, be quite a big negative for the emerging market. We put currencies under pressure, and I think it would cause money to flow back towards the US, towards the US dollar. And of course, the other classic safe havens like the Japanese yen and also the Swiss franc, it would likely push oil prices up. And that would hurt India, of course, and a lot of other oil importing countries. And of course, it'll lead to great concerns about gas supplies in Europe, which could crank inflation up again in Europe. So have a lot of negative impacts, some indirect, but some direct on emerging markets as well.
Jeffrey, in the same vein, may I ask you that if there was a view expressed yesterday by somebody that a conflict of this nature might not be a full-scale war, but be a show of strength, and presumably by Russia to show who's the boss, that if he's done so much, go out, do a small incursion, and then it be the end of it. My question to you is, I know you're not a political expert. I'm just trying to understand the market behavior. If such is the situation, that it's not a full-blown war, but either the tension diffuses or it's a small incursion which gets settled by conversations with Ukraine saying that, okay, we don't want NATO membership, so on and so forth. Do you think the return of risk assets, the reversal of crude prices in such a scenario could be swift, or is it difficult to say?
I think it could be swift, but I think you have to factor in that event a small incursion, given that um, President Biden and also the Europeans have said even on a small incursion, we would see sanctions, severe sanctions imposed on Russia. That I think small incursion or large incursion in the short run, I think it would intensify the various market moves that I've just talked about there.
Okay.
Now, longer term, if this all gets settled and Russia withdraws and we go back to not worrying about the Ukraine, well, then you'd start to see potentially money flowing back into the emerging markets. Of course, that will depend on a lot of other things, including, of course, as you imply, the Federal Reserve. But I think any small incursion here, even a small incursion as opposed to a full-fledged war, that would just crank up the demand for safe haven assets even more, at least in
Okay.
the short term.
Okay. Jeffrey, what about the slightly more lingering scenario? I mean, which is the inflation argument in the US, and I've seen different Fed governors give different commentaries. What's your assessment of this whole inflation versus interest rate argument?
Well, first of all, I come from the point of view straight away that inflation's at 7.5%, and interest rates are zero. They're just way, way too low. And so the point is that whether or not inflation goes much higher from here, and I'm not sure it will go much higher from here, the Fed is well behind the curve. And therefore, I think we've got to anticipate some significant Fed action over the next several months, beginning almost certainly with a 50 basis point rise in March, unless the inflation numbers collapse dramatically or the economy weakens significantly, neither of which I think will happen. It looks to me like annual inflation in the US will peak at around 7.8 to 8% in February or maybe March. We won't know that therefore until the data comes out in March or April. And so that guarantees you, I think, a 50 basis point rise in rates um, at the March meeting. I think the interesting thing for markets will be if then annual inflation starts to pull back a little bit as the base effects get easier. What do the markets do then? I think the Fed will still have a lot of work to do. So I think it's still going to lead to a lot of volatility in markets over the rest of the year. But one good sign for the markets down the road would be when and if annual inflation starts to peak. But my main concern here is I think there's a lot of interest rate increases to come in the US. 2% at the end of the year seems pretty much guaranteed to me personally. And I think possibly higher rates again in 2023, because this is a quite severe inflation problem, even though I think we may not be far from the peak in the actual measured annual inflation rate.
Jeffrey, final question really. How does India stack up in such a scenario? Because all the odds are stacked up against, so to say, crude, inflation, rising rates, what have you. The one thing going in favor is that even though the growth thus far has been patchy, 2022 promises to be a year of nearly outlier growth, even on the revised
Yes.
numbers downwards.
Yes, yeah. Now, let me just talk a little bit about emerging markets first, if I may, because the consensus
Sure.
view out there is EM is going to have a good year, given the valuation discount versus the US, for example, especially after the wide divergence of performance last year. Now, what you need for emerging markets to have a good year this year is you need to see this Ukrainian situation settled. You need to have some visibility about when interest rates in the US might peak, and I think we're going to get that for a long time. And I think you need to see the dollar weaken from here. And that will bring money into EM. I'm not sure that's all going to happen. This inflation problem is going to be there for quite some time in terms of its impact on monetary policy. And I think logically, although the dollar is overvalued, the dollar will probably stay relatively strong. So my assumption here is that it's going to be hard for emerging market currencies to do a lot of upside from here. Notwithstanding all the good work that everybody all talks about, and I agree with this, in terms of a lot of countries raising interest rates last year and getting real interest rates positive. I'm thinking about Brazil, I'm thinking about Russia, I'm thinking about Central Europe and lots of other parts of Latin America. Now, India's not done that. Indian interest rates are still very low. You've had a pretty aggressive budget in India with a wide deficit forecast and fairly aggressive disinvestment forecast as well. So I think India could be vulnerable to any new outflow from emerging markets should the Ukrainian situation get worse, should the dollar start rally further from here. But aside from all of that, and I know that's a very big if, India has some very, very strong fundamentals. The growth is good. Interest rates are low and the currency's been fairly stable, as we all know, and earnings numbers are suddenly getting a lot better. So I think a lot will be driven for India in calendar 22 and for you fiscal 23 by how does the currency behave, how is the economy going to perform, probably relatively well, and how quickly we get the Ukrainian and indeed the US inflation situation sorted out. But right now I'd probably have a marginal overweight in India within an EM portfolio, but against the background where I think it's going to be a very tough year for equities generally, a very volatile year, And I don't think it's going to be as good for EM as the general consensus is for this year, because there are a lot of challenges out there in general.
Thank you for saying it out as candidly as you can. And Jeffrey, really appreciate your time. Have a great night.
Thank you.
All right, viewers, that's as good a view as one can get in the morning. Really sucks in 10 minutes. We've given you, tried to give you the perspective on what a global voice would be thinking about. Jeffrey, of course, used to head UBS emerging market division and knows EMs very, very well. Okay, let's move on. It's 11 minutes done on the trade setup. Let's quickly move on to the other things. So, to my mind, the trade setup, I mean, Jeffrey's laid out the global context. SGX Nifty. Okay, let's do this. Just quickly mark the SGX Nifty after this. So I think the Indian market is a small push away from an extreme fear condition, but it may stay on for a while. The next crucial support at 16,680, which is the 200-day EMA, 200 EMA level. And irrespective of the war happening or no, just purely the crude boil up is negative for India. At 7-year highs, crude, the way it is, if it doesn't come off too quickly, then that's a negative for India. So keep that at the back of your mind. The SGX Nifty, just very quickly, if we can pull up and show, it is showing an uptick. Don't get conned into believing that this dip has been bought into. I suspect, or rather, that this time around could be different. So please be careful before you try and buy this dip, believing that this is much like what the past instances have been. Very quickly, let's move on to stocks. Cipla will start off negatively. Promoters are going to sell up to 2.5% stake in block deals. The total deal size at 1460 crores. The price is at a 5% discount. So suffice to say, in all probability, since nobody's in the rush to buy markets in general, the stock will start off low, could stay low. Some other numbers. Adani Enterprises, much as it's difficult to analyze Adani Enterprises numbers on a revenue, margin, net loss basis or a net profit basis, simply because it's more like a conglomerate of now incubating newer businesses. But the numbers were a bit of a disappointment, with the margins at 4.1% versus 6.6%. Could have a negative reaction, but the markets are going to start off okay, so keep that at the back of your mind. Again, iShares, the numbers left a bit to be desired. Revenues up 2%, margins at 20%. Again, a bit of a margin miss. Net profit down 14%, not as bad, but certainly weak. CLSA, though, I think encapsulated this well, and therefore I got this note. They have a buy with the target price of 3,300. They believe that Q3 missed expectations due to lower expected performance by Royal Enfield. The sequential decline in the SP and gross margins was led by higher raw material costs. And despite the earnings miss, though, because they have greater confidence in Royal Enfield volumes, they have raised their FY 23 and 24 earnings estimates by 8 to 9%. And that's why I reckon they have a buy with the target price of 3,300. Well, let's wait and watch. Balkrishna Industries, howler, and should be could see a reaction. Let me put it that way. The revenue growth numbers were good, by the way, so that is actually great compared to, I think, a few other tire companies. This one has done well, and remember, this is slightly different than the other tire companies because it just doesn't cater to the Indian PV or two-wheeler segment. It's got off-road, export, a lot of elements to it, and which is why the revenue growth was 36%, but the margins naturally cracked, and I suspect that the markets may not like that, but let's wait and watch. Coal India, bringing this number slightly lower because it may not have as big a reaction, but the number is better than estimated. The net profit numbers certainly better than estimated. Even revenue numbers marginally higher, and the margin number 50 basis points higher than estimated. So good numbers compared to what the Bloomberg polls were suggesting, and therefore this could be interesting. Okay, we don't have the poll numbers here, but the better than polls, essentially, better than the Bloomberg estimate was the Coal India number. So keep that at the back of your mind. Metropolis had a big candle yesterday and has corrected quite a bit. But the Credit Suisse note, I thought I should bring it simply because if people believe that it's done scores, they have underperformed. They had underperformed yesterday, which I brought to you. Remember, viewers, they have underperformed rating. The target and all is same. But I think they're bringing this note to say that despite the fall, the downside risk is still very high. Even though it's corrected 30% in the last 1 month, but still seems expensive and trades at 30% premium to India-focused pharma stocks, where entry barriers and ROC are higher versus the diagnostics business. Their gray sky scenario implies 35% downside to the stock. Will that happen? I don't know. The reason I bring this up is because Morgan Stanley's note on Metropolis is quite the opposite, actually. They have an overweight with a target price of 3,317, which has been revised downwards, but still higher. They believe that there's growth visibility driven by the asset-light network expansion, higher tests, etc., etc. and their EPS estimates are down by 4.8% and 5.1% for FY24 to reflect higher costs, which is why I think the target price has been cut. But still, the target price is 3317 versus Credit Suisse is 1700. So, well, it's currently at 2051 and corrected quite viciously in trade yesterday as well. Let's see if it bounces back a little bit because of the market mood. But pick and choose carefully if you're indeed investing into any of these names. I may have missed a few stocks, viewers, but we had to focus on the larger macro today. So we did that. Thanks so much for tuning in. Have a safe, profitable day ahead. If you're stepping out, please stay masked up.